Good afternoon, everyone, and welcome to our discussion on the outlook for the banking sector. The banking sector in Sri Lanka has been through several ups and downs in the past few years. Interest rates above 30%, now plummeting to single-digit rates in the time span of just less than a year. We've also seen worries on domestic debt restructure come and go, and banks taking very steep provisions in terms of the yet-to-be concluded external debt restructure. So with macro indicators moving a little bit more positively for the most part compared to the crisis conditions we have seen the last couple of years, how will the banking sector pivot as we move past the crisis and into a period of growth? To discuss these questions, we have with us a prominent group of panelists to share their insights on the sector. So we have with us today Mr. Thimal Perera, the Chief Executive Officer from DFCC Bank. We also have with us Mr. Damith Pallewatte, Deputy General Manager at Hatton National Bank. And we have with us Mr.Bingumal Thewarathanthri, Chief Executive Officer at Standard Chartered Bank. Firstly, thank you very much for taking the time to be with us today. So without taking further time, to start off this discussion, Damith, I'll start with you. In terms of interest rates, we've seen Treasury bill rates, for example, now moving into single-digit rates. Do you see this as a sustainable point? And what do you expect in terms of lending rates as well? Do you see a further drop, or what will we see in the next couple of months and couple of quarters?
Good afternoon. First of all, thank you very much for having me. To start with, it's an interesting question. So maybe 3-4 years ago, we have seen interest rates at 4-5%, and then we have seen it's going up to 30%. So now within say 10 to 11 months, it has dropped once again to single digits. So our expectation is, based on what we see, the circumstances and facts, it will more or less remain, and there will be further opportunity for it to go down a little bit. We expect with policy rates coming down to maybe about single digit between 9 and 10, and treasury bills and bond rates coming within the policy corridor. So there is further room for improvement in the rates downwards. So what we will see, given the inflation expectation of the country is 5%, around 2% plus or minus, which is now becoming kind of a gazetted number. So there will be interest rate being used as a tool in that sense to control inflation. So then what will happen is interest rate will pressure downwards, and we will see perhaps deposit rates hovering around 7 to 8% in maybe next quarter or two, and lending rates perhaps around 10 to 12%. So by any chance, if policy rates come further down from 9 to 10 to probably about 8 to 9%, so then this will sustain for a while. So what is interesting is all this time, maybe for last few years, we had an interest rate arbitrage in the market. That arbitrage has now gone, because now the treasury bills have come within the policy corridor, and AWPLR is well above the policy rate corridor. So then that arbitrage has gone. So that means banks now will be forced to deploy funds elsewhere rather than putting money in the government security. So all in all, what we will see, we expect interest rates to continue at this level. Perhaps there is opportunity to come down a little bit. Deposit rates will be low. That means depositors will be forced to invest money elsewhere rather than keeping money in deposits. That at some point should spur economic activity and go into some different asset classes than going into FDs in the banks. Lending rate should remain low, maybe around 9.5 to 11.5, 12 being the maximum, as much as the policy rates come down to 8 and 9. So then that will propel lending. So that's how we want the interest rates.
Sure. In terms of interest rates being so low, one would be expecting, as you mentioned, loan book expansion to come in. I think I would direct the question to all of you if you would like to give your input in terms of what you would be expecting in terms of credit growth. Is there appetite for borrowing being seen already in the market, or when do you expect it to start picking up when interest rates come down?
So I will get a start and I'll give Thimal to you. So we have seen credit growth starting to pick up maybe last quarter of 2023, and slowly it's continuing. So overall banking sector assets would have come down by about 300 billion point to point from 22 December to 23 December. But the fact is that the assets, the loan books have come down because your FCBU or dollar lending has deteriorated in the conversion. So your LKR lending book has grown because your dollar conversion from 365 to 320 or something, it has dropped sharply. You recorded the drop in the loan book. But in fact, if you look at deeply, your loan books would have started to grow slowly in the last quarter. We see with the interest rate coming down, demand is picking up, but not to our desire. So there is a lot more room to improve. There are specific segments of economy we would like to see loan growth coming from, specifically from the manufacturing, the export orientation, import substitutions, then the services like IT and educations. Those are where we would like to see demand, which we don't see as much as we desire. So we are hopeful with interest rate maintaining low, there is some consistency and foresight coming into the environment. So the demand for credit will pick up. You want to go there?
Thank you and good afternoon. We thank you, Cal, for putting this panel together today. Just to add to what Damith said, I think very similar to what he said, but just talking about 2023 for a moment, most banks or all banks, I think, consciously degrew their loan books. That was for multiple reasons. The interest rates were very, very high. So it was really not conducive for lending, and it wasn't really opportune for borrowers to take money at those rates as well. But like Damith mentioned, I think starting from early third quarter, going into the fourth quarter and continuing in this quarter, we are seeing credit growth mainly at the moment on the working capital side. So there is export finance, import finance, follow-on import loans, and so on and so forth. But what we are also seeing now with interest rates coming down to the levels they are currently at, we are seeing the appetite growing for longer term project finance. So predominantly on the renewable energy side, we've seen quite a bit of demand, and that I think commenced probably second half of last year, and that is continuing. We are currently looking at quite a few large projects in the eastern part of Sri Lanka, the northern part of Sri Lanka. And as the interest rates continue to be at these rates, I think there will be added demand for more project-based finance as people expand their business, the manufacturing facilities, as they get ready to meet the increased demand cycles. I think we could see more project finance-based lending picking up.
Thanks, Thimal. Bingu, in terms of, they mentioned in terms of project financing and working capital as well, in terms of trade-related credit, are you seeing that picking up, particularly with exchange rates being a little bit more stronger right now?
So, as you know, trade, imports and exports both degrew last year by like 8% and 9%. So exports predominantly because apparel had some challenges in their buyers markets. Challenges different from US to Europe, but overall, the volumes came down. The order books came down. So as a result of that, we've seen some amount of reduction on the apparel side. But overall, on the import book, the reality is like we just not picked up. Solely because you need to understand, so inflation went up by over 68%. Now it's about 5%. So all in all, if you look at from last year, 2022 March to now 2024 March, price points have, if you look at the price points, it's increased by about 70%. So salaries have not gone up at that level, right? Then the devaluation is a 50% devaluation from 200 to 300 plus. So that is also hitting you. You have a 100% tax increase, especially for the employee base, and for the companies 30%. So overall disposable income is very low. Though you open up the imports, there's enough dollars. You can talk about it later. There's enough dollars in the system now. There's not enough demand from the consumer because there's no disposable income. So income will only come with a lag effect. With the salaries getting adjusted, slowly turnovers going up, then the companies reinvesting back into the businesses and to people. So there's a lag effect. So, and also there's this sentiment that stability is important for Sri Lanka before growth. Yeah. So overall on the import book, because we are also a large correspondent bank, we probably handle the largest LC confirmation volume in the country for the local banks. We're not seeing the demand coming back. And also a lot of the suppliers also have gone into open account and advance payment and things like that. Clients also have moved into cash cycles, buying on cash, selling on cash kind of thing. So overall import loan demand has drastically come down. Credit to the private sector year on is about less than 3% degrowth actually. But from June, every month we've seen slowly credit picking up. So that's a positive. But one thing to note is, you remember there was a time from 2014 to 2019, the economy growth was something like 3%. It was a very slow, very low single digit growth. But with the credit to the private sector was double digit. And we saw the LIs going up after 2018. 2020, I think LIs went to close to 5%. So that's the other danger. When the economy is not growing, if you keep lending to the economy, again, you'll create a massive NPL book. So you have to be very careful in terms of what sectors you want to put money and how you want to grow the economy.
Thanks, Bingumal. I think that leads on to our next point of discussion, which is with regard to non-performing loans or stage 3 loans right now. Damith, I mean, we've already seen it reaching close to 14% levels industry-wide, certain banks reporting much higher figures. Do you think, we've reached the top of this, or is there more pressure that we will see going forward? What do you expect?
I believe we have peaked. If you see 22 December, the banking sector stage 3 ratio somewhere around 7.5%. So which has increased to 11.5% by 2022. Then 23, it is about close to 13%. So then that means it's plateauing by now, because there are a lot of action the banks have taken in 2023 to manage it. So one such thing is that we have special asset management unit, business revival unit, whatever you call it, so which facilitated the business revival piece. Maybe it takes a longer time for them to settle bank debt, but still banks taken that hit and facilitated the business revival. So that has helped over a period of time, maybe 6 to 9 months, them coming out of stage 3 and becoming slowly performing advances. So the challenge for the banks are that, so we can continue to support. We also need to have a reciprocal support from the customer side. So there is also a trend that we have seen. Whilst banks are willing to support, there are, contribution that has to come from the customer side in terms of willingness, commitment. So they are also willing to take different action to regain the core business rather than working on peripherals. So that if both sides work together, we will see there is a further potential to improve on it, and it will further the stage 3 will reduce. And the other challenge for the banks are that associated with the stage 3, we have impairment. So that directly hits the P&L. So if you see how much impairments the banking sector has made over the last couple of years, it's mammoth actually, it's significant. So when the stage 3 loans are coming out, it helps the bank to go back and support the economy as well. As Bingu said, if the economy is not growing, if we start lending and continue to lending, we build on that stage 3 portfolio. Now we are seeing activity slowly picking up. Interest rates are coming down. There is a demand slowly picking up. If the businesses continue to have the commitment and operational capacity to sustain, so then we will see NPLs are further coming down. So that's what our expectation as well.
If I can just maybe add in a little bit more in terms of now seeing the peak, when do you maybe start seeing it trailing off? Some point this year?
I would say half year would be a better bet. Once again, there are uncertainties around it, the economy plus maybe the potential election signs is another one. So how do the businesses behavior in light of that? How the environment and the economy behave is something yet to be seen. So then those can have dampness, but nevertheless, we believe that NPLs and the stage 3 now should start getting better and better.
Got it. And Thimal, just to add a little bit of color to that conversation in terms of what are the sectors that you're really starting to still seeing stress on, and what are the ones that have actually started repaying some of these and moving out of maybe the stage 3 category?
Right. So very clearly, I think I also believe that we've seen the peak of the impairment cycle. So it should plateau and begin to come down as the year progresses. One reason is that over the last couple of years, whatever that had to cross into stage 3, I think have crossed. So we've seen the worst of the impairment cycle, I would say. But having said that, there are a couple of industries, namely the construction sector, then the vehicle importers are still in very much stress. So these are sectors that we could continue to see facilities crossing into stage 3. The revival particularly has obviously been in the tourism sector. That was a sector post the Easter bombings have seen a lot of stress. We've given moratorium after moratorium to that sector over the last 2-3 years, but now with obviously the tourism numbers improving by leaps and bounds, we are seeing that sector rebounding quite nicely. We are seeing a lot on the agriculture side, even vehicle spare parts, and so on and so forth, picking up. So I think the big stress sectors going forward would be, I think, the construction sector and, of course, the vehicle importers. Right. So what I'll two parts to that question. Sure. I'll take the first part first. I don't think it's going forward. This is what we have been doing for the last 2, 3, 4 years, probably. Restructures, rehabilitation of facilities and customers who have been seeing stress due to the economic downfall. So we've looked at everything from interest rate reductions to tenor extensions to interest waivers and write-offs in order to make those facilities perform and in order to match the cash flows of those customers along with the to the loan repayments. And that is what we have been doing over the last 2-3 years, sitting across the table, understanding what their cash flows are and trying to match the repayments to suit those cash flows. So that will continue. And with the revival units that the central bank also is now driving at the bank, these are things that we've done over the last 2-3 years. We already have revival units based geographically across our regional offices and our regions across the 140 branches. So that is going to be our primary focus going forward. You touched on an interesting point on Perera. And this is something that is being spoken about quite widely in different circles, in different social groups and so on and so forth. So it's worth talking about it a little bit. Firstly, we need to understand why Perera, right? So I think there are 2 main reasons. One, we are basically lending what are depositors' funds, right? So this provides a safeguard for depositors as well. The Perera rights that are afforded to banks to recover the money. The second thing is banks take comfort in the fact that there are Perera rights, right? So when there are willful defaulters or as a means of last resort, we deploy Perera to recover monies, particularly to safeguard obviously the bank's capital and profitability and so on and so forth, and depositor funds, right? So this is not something that we do as something that we like to do or want to do. It's not that banks want to own hotels and houses and put people out on the roads. That is not, definitely not, we are not in that business. We are in the business of finance, right? Not real estate. So it is something that we used really to bring defaulters to the table and to put some pressure, particularly willful defaulters. So the danger with all the discussions that is going around is there is a small group of people who are talking about this, and then there is, I think, they're getting political mileage for whatever reason. And that is the danger, because if the Perera rights are taken off, the bank's willingness to lend, banks are obviously going to be a lot more cautious and a lot more conservative in lending. So that is not going to help the economy and the SME sectors that need bank finance to really grow and prosper. And the other thing that can happen is the depositors' funds can come under pressure if the Perera rights are taken away. Right. So I'll stop there and let my colleagues also come into that.
Maybe add a little bit more, Thimal, to what you were saying. So when crisis hit, what we have seen is whoever who have got impacted, the first thing they come to the bank and say, we are finding it difficult to pay debt. Can you give us a concession or moratorium or whatever we have done? And when the businesses revived and started generating revenue, the last thing they want to do is start paying the bank. So there is a disparity that we see in terms of, as he said, in managing depositors' funds. Second thing is we have experienced, because last 3-4 years have been very experiential, informative in terms of identifying certain behaviors for banks as well. It's a journey. So we have identified 3 categories of borrowers. So during the crisis, everybody was down, but when they were given some breathing space, given some livelihood, there is a segment of customers who came out of it, who guided by the advice, we have supported them, they have, revived. And we have not given concession, we are given. And there is another segment of customers who are still struggling, but with the bank support, they are a signs of recovery. There is a commitment from that side. There is a reciprocity. They are willing to work with the banks. They are conservative. They are business focused. So that's a second segment. There is a third segment, which is a very small component of those borrowers. More than willful defaulters, there is diversion of funds, investments in private assets. They are not concerned about the business. Maybe personal assets, personal life have been extravagant. None of those have been stopped, but only the bank servicing has stopped and need further concession on the banking advances. So we need to clearly identify who are those segment of customers, and we need to help all of them to come out. But your way of treating them has to be different. Otherwise, we are not treating the customers who are really committed, dedicated, coming out, working hard, a justice by treating all of them together. So I think that's where the conversation on this Perera comes up. If you really go deep and see where this noise, we will understand, from what category of customer this is coming. The third point is, if by any chance there are some changes that probably might come up, the challenge the banking sector faces is, one is, how do you direct funds to those riskier segments without a comfort? Second thing is, in a time where we have seen interest rates are low and down, we are encouraging lending at lower rates to spur economic activity. When the risks are going high, banks might have to price the risk. So then once again, your borrowing become expensive in such a case, and borrowing will be limited and expensive. So that does not help economy to grow. And if the economy doesn't grow, there are further consequences that can come up in terms of GFM. The gross financial needs for the country, as said by IMF, there has to be a certain level of GDP growth coming in. There has to be a certain level of economic growth coming in. If that doesn't come, you will fall short of all the milestones that we have set. So it's far-reaching consequences. I believe whoever who make decisions have full access to those consequences and give due consideration in making the right call. But banks' point of view, I think we are very clear. We are there to support. We are there to guide. And only thing is, we need to differentiate action for different types of borrowers to do justice for everybody.
I think both of you have mentioned, discuss a lot of things. In terms of numbers, these numbers are very small. We talk about like 600 cases and 38 billion rupees worth of loans under Perera at the moment. It's about 0.4% of the total asset book. That's something to consider if you're trying to protect that group and you're punishing the entire asset base. And like Damith said, immediately the pricing will go up because our RWA models will change. You will have to seriously consider when you take a mortgage, whether you can really, if you can't really realize the asset, then what's the point of getting a mortgage? The entire risk model we have to relook at. So that will definitely come with pricing. There'll be a large implication to the whole growth agenda, because right now we are really struggling to kickstart the lending engine. And if you slow down the whole process, I think there'll be larger repercussions for the growth agenda.
Thank you everyone on that. Moving on in terms of deposits, Bingu, if I can direct that to you, how is the demand for deposits changing? I think there was at one point a flight to safety in terms of the risks associated with the domestic debt restructure. To some sense, international banks, I think, got a little bit of that. Do you see that continuing? How is, even in the terms of the local banking space, how do you see deposits mobilizing right now?
Yes, so some amount of deposits came to global banks, I believe, because of the AAA rating that some of us had. But that's predominantly from the multinationals who are really looking at a rating. I believe that larger part of the clientele of the local banks stayed with the local banks. Of course, some moved around because some banks started offering 25, 30%, right? Some banks offered 30% on 5-year deposit. You really double your money, you go beyond that. Actually, when you deposit for 5 years at 30%. I believe that part is anyway over, the flight to quality one.
Yeah.
But multinationals will still place money with AAA rated banks because they have separate guidelines from the regulators, their credit policies, their treasury policies are different. But overall, what we can see is we still see the liability base intact. We've seen a shift as an industry, as shift of every client looking at what's in my savings account, what's in my current account. I don't want to lose out. So can I move, 90% of that to a term deposit or to treasury bill? Because they all learn that, these interest rates are very high, 15%, 20%. Why don't, I don't want to lose out. So we've seen the CASA balances from CASA to TD, a big shift in the industry, not very beneficial for the banks. Banks also had to then, take it, offer it, then go and park money with central bank. That was a vicious cycle. We are slowly unwinding that. But overall, we have not still seen the deposits moving out of the banking sector like to equities.
Yeah.
However, a lot of the sophisticated clients are looking at money market products very clearly. Every bank, I think the local banks got some kind of a money market, arrangement with a fund or their own fund. So those investment products are very common. Clients are used to those. They behave like savings accounts, and they are on apps. So we have seen clients moving into those because there's a 4%, 5% arbitrage when you go into those products. So that move is happening, but we have not seen suddenly clients moving out to equities. But we've also seen with the treasury bills maturing now, no point of going there 10, 11%. So that money is now slowly coming back to us. That's another inflow that we see. But predominantly clients are, in terms of investment, they're also very careful. Land prices have not gone up significantly. But for the finished products like apartments or finished, houses, because people are migrating, there are good, opportunities to buy assets. I think for those, a lot of people are moving their funds into those. We can see that market picking up, especially finished products, apartments. The prices have gone up by about 30%, but has stayed gone up 30% by, I think by mid last year it went up and it's stayed there. It's not going any further, but because building a house is very expensive now. So on the finished products, I think the apartment owners are really making money right now. So that's where the money is going. But overall, we have not seen a big reduction in the CASA, in the overall deposit balances.
Got it. So in terms of net interest margins, you're seeing rates obviously coming down both in terms of deposits as well as lending rates. I mean, we saw very high NIMs across the banking sector last year. So what can a bank now kind of deploy in terms of trying to retain some of these margins even while rates are coming down?
Simple answer is we change the pricing because banks end of the day work on NIMs, right? So we have to maintain some amount of NIM consistency. Last 1.5 years or last year was a very unusual year. If you look at the NIMs of the banks, I think everybody kind of had very decent NIMs. Also, we paid very high amounts for deposits. Some banks paid 25, 30%. Like I said, while you were charging 20% for assets. So overall, if you look at, of course, you can say NIMs went up last year, but globally, if you look at globally, NIMs have gone up because Fed rates went up, right? I think that is also over now. Globally, every bank is factoring a NIM reduction for 2024 and 2025, and we will also do the same in Sri Lanka. Having said that, we will also have to lower the deposit rates, no doubt. We can't offer the same 10% for savings accounts and all of that. I'm sure banks have already reduced. All the banks, I believe, most of the banks have reduced rates to mid-single digit or slightly above, maybe. So we will have to maintain consistent margins because the reality is we are getting into Basel III in terms of large exposure policy. We can only lend like 25% of our tier 1 capital to a particular entity. So building up buffers, capital would be critical for the bank. So people should not worry too much about the bank's profitability. Banks also contribute, I think 50% of the profits go for tax, right? I think one of the highest, tax paying industries, I think bigger than tobacco now, if I'm not mistaken. So it's very important that we stay in the business with well capitalized balance sheets to navigate the crisis, because the crisis is not over yet. If you look at what's happening in Red Sea and what's happening around us, very clearly Sri Lanka is not ready for another black swan event, period. There's no debate on that. We are not ready. So it's important that the country build buffers and we also build buffers as industry. So if banks are stable, we can support the revival process better.
Thanks, Bingu. Moving on in terms of a question on debt restructuring, it has been a top of mind question, I think, for banking sector overall last 2 years since we defaulted. External debt restructuring is, of course, still going on. As a result of that, banks have undertaken significant provisions. I think it's starting to come down. But do you think, Thimal, that we will see a little bit more in terms of provisions going forward? Is there a guidance that has been given for further provisions?
So that is the big unknown. At the moment, I think the industry is around the 52% level on the provisions. There are different schools of thought on this. Some people think that maybe the provisions by 31st March need to go up to about 55%. Some people think that the current levels are sufficient. So a lot will depend on how the negotiations with the foreign creditors go, what the ultimate day one impact would be, what the capital haircuts would be. So at the moment, it's difficult to comment, but we are comfortable, I think, as DFCC as well as the industry, I think, where the provision levels are at the moment.
Okay. And Damith, in terms of probability of default, I think there was changes made in the last couple of years because of this risk coming up on the debt front. Have adjustments already been made in terms of probability of default, because we've seen the DDR go through? And what do you see kind of being the next big risk factor for the banks? Is it the EDR or is there something else?
I would say the probability of default, to start with that, we have not seen any improvements have been factored in, because we are, as Bingu said, we are still in the crisis.
Right.
We have not come out of it, but we have seen signs of coming out. It may be too early for somebody to make a positive adjustments on the probability of default. Maybe end of this year is something that we can look at with certainty how those probabilities can be eased. So then on the risk factors that you have asked, perhaps I might have maybe 2 or 3 risks that the banking industry might face in that sense. So number one will be the cost and the capital. So the cost of compliance is very high in banking. And the systems maintenance, the risk management framework systems are significant. So even if you look at banking infrastructure, if you go to a town, you get 10 ATMs of 10 banks. Each one has a different system. Each one has a supplier. Each one has a equipment supplier, service supplier. So all those are costs for the bank. So those costs plus the compliance, which is coming up in terms of AML, KYC, terrorist finance, whatever you call it. So those are tightened. So it will become tighter and tighter. So then the base cost that you need to run a bank is significantly high. And we have seen since of late, even the regulator is persuading opportune agenda of consolidation. So that's something I think which will ease out to a certain extent management of cost. The second thing is people. We have seen a lot of talent is moving out of the country. So as much as banking is now digitized and technology driven, so we need to have proper talent in the industry to run. So that is essential. So that banking sector will see how the talent is moving out, impacting its workforce continuously. So third thing I would see is, so a lot of banks are moving digital. Technology platforms are coming in. How about information security? If we get one single big hit that can impact significantly across the economy, then everybody will start looking at it, information security, serious. Because so far we haven't had something serious, maybe we are looking at as a, hygiene or nice to have. So we need to move away from that and take very seriously and spend right amount of money, technology, people, and whatever it takes to make sure your assets, your information, your data are secure. And you are given that comfort and confidence to the customers. Yes, you are digital, you are in cyberspace, but you are secure. So I believe those are the 3 risks which are there, and it continually emerge differently in time to come for banking.
Thanks, Damith.
Can I add to that? So I think any kind of postponement of EDR will be a huge risk for the country, because we still have a default rating. So still large exporters will always ask for a confirmed LC from Sri Lanka, and then cost is very high. For oil LCs, the confirmation is very high. So as a result of that, there's price built into the entire energy bill and all is extremely difficult to run at a default rating. So any kind of postponement from June this year will be very difficult for the country because you're also getting the election cycle. Second biggest risk is the election, because depending on who comes to power, if there are drastic changes in the economic policy, then how you navigate the IMF program will be another thing to discuss. While we all agree that we need to sit and negotiate to what level, who will do what, is something that we have to wait and see, because we can't completely derail the work that we have started now. It's very important. While we might push back on certain things, on certain reform programs, especially expenditure cuts, repurposing the government sector, bringing the government card down, then making sure that we protect the right people in the country without letting them migrate, especially in the government sector. A lot of people are migrating. So that whole piece is very important. Then cost reflective pricing is something they implemented, but again on taxes, there are proposals to look at strategic investments. Can we look at fintechs? Can we look at junior level employees? Should we exclude them from the tax net? Those are some of the things that anybody will have to sit and negotiate. So it's a give and take with the IMF and other multilaterals who are supporting us during this crisis. So the risk is like what economic policy a new party can come up with can be a challenge for the country. So carefully watching that space as well. The third thing is 70 countries are going into elections this year, some sort of election. About 40 countries are going into national elections, presidential, parliamentary elections. That will create a very different geopolitical, environment, or geopolitical dynamics will change in the world. And Sri Lanka, we believe, is a very vulnerable country for geopolitics. So how we again, new leadership next year navigate the geopolitics around us would be a very critical question to be answered.
Thanks, Bingu. So in terms of speaking about risks, I think the question now is, how does a bank build buffers in terms of their capital position? Thimal, if I can direct it to you in terms of requirements for building capital buffers and the capital calls that banks might be taking, particularly with the risks that are coming up.
Right. If I may just comment on the EDR that Bingu spoke about, there is another element there that is actually quite a significant thing that is hanging over the heads of the banks on the tax element on the EDR. So we've all built in different tax reserves on the EDR component of the taxation. At the moment, there is a lot of uncertainty about whether that is going to be allowed as a deductible. So there is a lot of representation made by the banks, but if that doesn't happen, and if that is not allowed, then there is really a double whammy on the banks, while we have to take beta 50, 52, whatever, 55% hit on the PNL as a result of the haircuts. There is also an element that there will be the taxation, the deferred tax that the tax has been paid, and we've taken built it as a deferred tax asset. There's also a possibility that that amount of the deferred tax asset could convert to actually a tax expense for the banks, and that means a PNL hit and obviously the capital impacts and so on and so forth. So I just wanted to put that out there as well. In terms of building capital buffers, at the moment, I think Tier 1 is going to be a challenge. I think most banks have issued it over the last 12 months or so debentures which are convertible. So raising Tier 1 capital is going to be a significant challenge at this point in time. Having said that, the banks are well capitalized at the moment. The capital buffers are healthy, but there are certain uncertainties like the EDR, like the taxation that I spoke about, that could place some pressure on the capital of the banks. So at that point in time, if we are struggling to raise Tier 1 capital, that could basically raise some added pressures in the banking industry. So that is what we got to be careful about. That is why the decisions that are made by the policymakers need to take into consideration all these aspects. It's very, very important to understand the current challenges, and that's why the EDR being concluded by June is very important, because then we can obviously start thinking about a rating improvement for the sovereign, and then we can see foreign funds coming in, even foreign investors, interest rates rising in coming into Sri Lanka. So that all these are at the moment fairly big unknowns. But to answer specifically your question about building capital buffers and raising new capital, tier 1 is going to be a challenge for the next 6 to 12 months until at least we start seeing a rating improvement of the sovereign.
Understood. I think we have quite a few audience questions starting to come in now, but just before we go on to that, Bingu, just one question in terms of the dollar position of the banks. How is the dollar availability? How has the accumulation been, particularly with the BOP position being in a surplus?
Yeah, we are now over, I think, 3 months of import cover, including the Chinese swap that we have for $4.6 billion of reserves now. From a $30 million when the default happened to $4.6 billion, of course, take the 1.4 Chinese swap out. Even then, you're $2 billion is a significant achievement in my view. If you compare with the regional peers like Pakistan, Bangladesh, even other default countries like Ghana and all of that. So once we reach like 4 months of reserve, we are like any other normal country that's operating with access to international bond market. There are many countries operating with 4 to 5 months of reserves, right? So I think enough dollars from that perspective to a level where banks are struggling to park money. They're looking for options. They've gone into US treasuries for the first time, so multiple nostro accounts, because we also have challenges in terms of how much you can park. So we have enough dollars. It's just that we would like to see the demand picking up.
Right.
Dollar is absolutely not a problem, because for a day, like for a month, we get like what, $500 million worth of worker remittances. Tourism income was gone up like $250 million, and your BOP gap for a month is like $400 to $500 million roughly. So the tourism, income is just accumulation. It's actually building up buffers. Multilats have helped us last year over $1 billion. That money also came in. This year also we're expecting another IMF tranche to come, more ADB and World Bank money to come. So most of that will of course go for fiscal support and all of that. But overall, the external sector story in Sri Lanka is excellent. I would say the best out of all the default and near default countries in the world.
So I think just following on from that, there's a question from the audience as well. In terms of the banks building dollar buffers above the NOP positions, have you built it to cover up for potential USD losses in terms of the sovereign bonds restructuring?
All that has been done. We are ready. We just want, I think I'm not part of the whole ISB restructuring because SCB didn't have exposure, but I think banks are waiting to see an end to this. Banks are ready.
Sure. Just also, there's a broader question in terms of the outlook for the USD LKR exchange rate, and if anyone has any views in terms of what you expect, particularly as you mentioned with imports, you're expecting it to slightly start picking up. What would your expectations be on that?
So if I may go first, so we always expected a stronger LKR as Standard Chartered. We predicted 325 last year. We ended up 325. We thought our initial expectation in the first half was slight depreciation, but we can see very clearly there's enough work remittances and tourism flows coming in, and we're not settling debts. So we expect a stronger rupee in the short run. It can even reach close to 300, but eventually it will depreciate by about 5%. Because what can happen is by March, some salary adjustments will happen. By June, we'll come to the end of all these things, hopefully. Then some FDIs will come. The whole engine will start. Moment that starts, the import bill will go up. And not to forget, everybody's forecasting oil at something like 90 to 100. One bank yesterday had said 100. Oil is hovering above 80. So each dollar of crude increase is a $4 million cost for a month for Sri Lanka. So that's the way it works. $10 of crude means $40 for a month. That's $500 million roughly. $480 million is $500 million. So $500 million stress on the BOP is somewhat a stress for us. Rupee will depreciate, no doubt. So with Red Sea crisis, what's happening in the Middle East, there's a big possibility of crude going up. So we should not underestimate that. And the import demand will pick up when the credit picks up and the income goes up. Import demand will go up in the second half. Right. So 5% depreciation from a 310 would be a reasonable guess in my view.
Is that in line with everyone else's views? Any views at all?
We have a slightly different view. We don't see very much change from where it is now. We expect a band of about 320 to 340. 320 to 330, basically the 330 to 340 band will kick in if the debt repayments commence towards the second half of this year. Plus, like Bingu said, the import demand increases, vehicle import, maybe some sort of vehicle imports are opened up. we think that the exchange rate could move to between 330 to 340. Otherwise, our view is roughly 320 to 330. So slightly higher than what Bingu predicted. But I mean, it's anybody's guess. Right.
Sure. Just another question on the external debt restructuring front. There's a question on the likelihood that banks will be allowed to take their USD sovereign positions back in terms of LKR. Is that a possibility that you see?
Damith should answer that question. So it depends on your balance sheet situation and all of that. But these are huge amounts, so I don't think we can take the whole thing in LKR.
Yeah.
A certain portion, maybe some banks might take. We have gone through this during SLDBs. I think we managed it. So depending on where you are with your positions, I think each bank will have to answer that question. I don't want to give an opinion on this one. Each bank situation will be very different.
Sure.
Yeah.
In terms of credit cards outstanding, there's been quite a bit of an increase recently. Has the overall the settlement cycles, how have they been in terms of credit cards?
But I think the more transactors, a lot of people settle on time.
So we have seen receivables have increased. In terms of stage 3, that is a stress piece. So we have not seen that much of an adverse movement, meaning that people have started using credit card as means of financing day-to-day activities. So that shows that, when you don't get your disposable income enough, they try to revolve around that. So we got a lot of revolvers accumulated than, settlers. So that may be why we have seen receivables actually have gone up a little.
Sure. There's also a question in terms of, again, talking about the debt restructuring and so on. The IMF documentation has spoken of 9 banks that have needs for capital raising. Is there any more scope for mergers within the sector?
So I believe because of this large exposure policy, at some point, there'll be a push for certain banks to merge with Basel III coming in, IFRS 9, and finding capital to manage all of that. There'll be a push for certain banks to merge. But I think we don't expect regulators forcefully, do mergers in Sri Lanka at this point. But naturally, some banks might think, okay, let's merge and grow. That can be a possibility when the economy kickstarts. Yeah.
In terms of, there's one question with 2 parts in it. Any comments in terms of the changes to the Banking Act, and also whether banks will have to mark-to-market collateral in otherwise performing loans when assets sold off in Perera auctions don't yield expected values?
What is the first question?
In terms of any comments on the changes
Right.
in the Banking Act?
Yes, there are significant changes actually. What we have seen, especially in the large exposures, which used to be 33% to 40% of your total capital, which is tier 1 plus 2. Now it is dropping to 25% of tier 1. Effectively, that means you are dropping your single borrow limit by 50%, somewhere around. So that means the large groups who enjoy credit, maybe somewhere close to SBLs, need to shed over a period of time. Of course, the central bank will give time, but nevertheless, they have to shed that credit. So those large groups run some part of the economy. So if their debt is, brought down, if they don't have a way of financing and continue that level of operations, there will be disturbance economic activity. So what we'll see, so there is a plus and a minus both. The positive side of it is that they need to raise that money either in the capital markets or from overseas. Both are beneficial to the country. That opens up a different set of markets. The second thing is that, so when the single borrow limits are brought down and you are forced to support the smaller businesses, so that enable that necessary growth in the engine where, larger community get benefited. So that means banks will be indirectly directed. You go and support small and medium industries when you can't, accumulate debt on the large corporate, which are less riskier. But now when you start going into multiple small type SME loans, you accumulate risk in the banking sector as well. So that is something that we need to be mindful about.
I think the second part. Just repeat the second part. If
In terms of mark-to-market on collateral in otherwise performing loans, if the assets that are auctioned off in terms of the Perera auctions don't yield the expected values.
Yeah, so there are two types of impairments. We do it based on cash flows, and then the other is based on collateral. So if the Perera rights are taken away, obviously the recovery time period extends, because if you have to go down the mortgage bond action route, that's a much longer recovery process than Perera. So as a result, the discount you take on the collateral is going to be higher. So, and as a result, the impact on even performing loans and the collective impairments is going to be quite significant for the banks.
Thank you. There's also a general question. I think maybe Damith, you can comment on this. How the staff turnover has been in banks. I think you've already kind of mentioned this with migration cycles and how you're expecting the cost pressure with staff salary escalations and so on to kind of replace these migration cycles taking place. How does that affect it and how do you manage it?
So I believe there are multiple angles to that. The first one is the negative side of it is experienced staff moving out. So that created a vacuum where there are certain element of knowledge is lost from the industry. So that needs to rebuild, which takes time. The second thing is it created an opportunity for a talented young team to come up and fill into those shoes. So then that also will take time. The unhealthy part is now the experienced staff has gone. People who have some level of knowledge has moved out. So now there is a price war between banks amongst industry, even though you don't have that proper knowledge and skill set, but you still attract them for a higher price. So that inflates the right price that we pay for the right skill set. So that is kind of adversely impact because you unnecessarily push your salary scales up where we would have managed a little better in an environment where we have so much of cost pressure on capital, risk management, compliance, systems, maintenance. Those takes front stage, right? Nevertheless, we need people to run, but those are quite manageable, I guess.
Thank you. I think we have time for maybe about two more questions. In terms of credit growth, there's, in December, there was an increase of 97 billion in terms of private sector credit. How has the trend been in January, February, if you have any insights that you can provide?
Haven't seen much difference. It's in a all common sense, it's a lackluster approach that we are seeing in building demand. Maybe January, the difference is VAT built in, which wasn't in December. We have seen incremental credit growth because just before 31st December, we have seen stock piling up, stock building by some of those, the retail and wholesalers. So that would have also increased the credit demand. But January, all of a sudden it comes on. Generally, January is not a month where we see a lot of credit demand. So I don't think it's a right comparison, but the market sentiments that we see, there are still inquiries coming, people are planning certain activities, but those are not really coming into the center stage to the level of disbursement of money to make it on balance sheet assets.
Understood. I think maybe taking on the last question, maybe Bingu, you can comment on this. You said that banks have already built up a considerable dollar position. Is it possible that you would continue this? You could continue this in the absence of further government borrowing, USD terms, and also lackluster export credit demand? Is there a possibility that these high dollar positions you built can actually sustain throughout the year?
Yeah, so there are a couple of things I think I couldn't complete when I actually commented on the dollar rupee for this year as well. So there are a few other things to monitor. One is the cash outflow for the debts running up 2027. So ISBs will start to pay after 2027 as per what we're negotiating now. Bilateral debts, we got 10 years moratorium, right? But there's accumulated interest of 1.4 trillion billion, whatever. We have to get that number and see how we're going to negotiate that in terms of repayments. How much we will repay this year, next year, and all that, something we need to understand. Multilateral debt for a month is like $75 million roughly. That takes you up to like $1 billion. Even last year we settled that. So we don't have a problem settling multilaterals. But the other thing to note is the priority borrowing. We borrowed money from India during the crisis. That money is not under debt restructuring. That's so close would be $2 billion. So that will also we have to pay before 2027, if I'm not mistaken. There's a swap facility and a trade facility and all of that. So understanding the cash flow, cash outflow of that could be critical to make a good judgment. But overall, my sentiment is because your worker remittances are now continuing because we lost our people, they're all gone. At least people who went to Middle East and Korea and Japan, all these places, they're sending money. Tourism, if we don't, derail anything, if we continue like this, it will only grow, right? We have very clearly, we can reach the $4 billion mark that we did in 2018. So that's a possibility. Then very clearly the multilateral support is there. So we can definitely, our reserve target is something like 5.3 billion for this year. We're already 4.6. So we don't see a risk to that as well. So overall, yes, there is problem with exports, but again, exports. Overall apparel industry globally has come down by over 20% globally, right? Sri Lanka has not seen the full 20%. We also have taken market share. We have taken orders from other markets. Sri Lanka is still coming to Sri Lanka. The certain markets are de-risking, it's coming here. Certain things have gone out of Sri Lanka due to different reasons. So we don't see that full impact here. The overall export book came down only by 10%. I think it's an outstanding delivery from the export side also. It's a small export book. And fisheries, fruits and vegetables, other commodities, everything has grown, including tea is performing reasonably well in my rubber products, all of that. So that's why we are hovering at 8-9% of degrowth. So we don't see this year it has to go up. There's no reason why the US market is, I mean, US never went into a recession to begin with, right? UK, Europe, they were in stress. They will continue with stress for a while. The reality is that. But US, the data coming out of US is very promising. They have found a new equilibrium to grow the economy at a certain rate, 3% growth when the inflation is high and your interest rates are like 5%. And the easing cycle is starting, we believe, and EBA might do it before US, but overall both regions will cut rates this year. So the demand will pick up. So we don't see a major stress there, but cash outflow for debts is something that we need to analyze and understand. We don't have the data with us.
With that, I think it was a very positive note to conclude on in terms of our expectations on the external side. With that, we would come to the conclusion of our webinar. Thank you to everyone that joined online, and thank you very much to each of the panelists for sharing your insights on this topic.
Thank you.
Thanks, sir.
Thanks.